Hey, good afternoon, everyone. My name is John Jimenod, Regional VP of Sales here at Angel Oak Mortgage Solutions. We'll get started here in a minute. We're also hoping one of our senior account executives can join us, but he might be having some technical difficulties. But I'll introduce our subject matter experts here in about a minute. Hope everyone's having a great month, and we're getting ready to get into a high season here, and we can feel it here on the non-QM side. So get started here in about 45 seconds. Still some people logging in. Today everything we're going to do today is from our website. This is going to be recorded. We will get this out before end of day tomorrow. All the questions come through a question queue. We have some people answering questions on the back. We'll also verbally share those questions with everyone here and get them answered for you. So a lot of changes here on this debt service coverage is what we're going to cover today. We've made some enhancements over the last 30 to 60 days. So this is a good time to join us. So, all right, people still logging in. Let's all right, let's get started here. My name is John Jimenod, Regional VP of Sales here at Angel Oak Mortgage Solutions. Thank you for joining us. We're supposed to have two subject matter experts, but one of them's having some technical difficulties. So if you were expecting to see Oscar here today, sorry. Hopefully he'll join us when he gets through the technical difficulties. But love to introduce a coworker, good friend, Chris Taylor. Please introduce yourself.
Hi, I'm Chris Taylor. I'm in the Denver market, been with Angel Oak for 8+ years, and excited to be here today to talk about one of our most popular products, or it's become now our most popular product. So
yeah, Chris, why don't you share what you've seen with this product and your thoughts behind the growth of the percent of the total pie here.
So I kind of coined the term dormant customer, and that's the borrower who's sitting at 3.5%, never moving, never doing anything. We almost have to have a funeral in a way for the owner occupied with that borrower. Having said that, those borrowers have become really good borrowers in other categories. We have other webinars on our HELOC product, but the DSCR has become really popular, and it's for investment property loans and specifically a lot of short-term rentals. That activity is really moving. It's a big percentage of our volume, and it's what I get calls on almost every day. And so that part of our market is really thriving.
Yeah, Chris, and usually historically that program has been in maybe the high 20% of our total business. We were just talking about it before we came here live. It's closer to 40% now. That's significant. That's significant. So what we're going to do here, let's do a poll, Chris. Let's launch the poll question. Who has do we have a poll here? Yeah. Okay. Who has originated and closed a debt service coverage ratio program in the last 12 months? And I'm just going to pull up a little slide while everyone's voting on this. Chris, can you see what I have up here?
Yes. Mm-hmm.
Yeah. So 34% of the homes are rental properties. 70% of those are owned by individuals, and 50% of them are single family homes. And that's 44 million US households rent their homes today. So I know I just threw a lot of intel at you, but we're going to teach you all how to be experts on the debt service coverage ratio program. So polls in, 60% have not originated and closed a debt service coverage ratio in the last 12 months. Let me tell you, these are probably the easiest loans to close, and it's those investors that are still purchasing homes even in this higher rate environment. So Chris, let's jump into it. Like I said, this is being recorded. Everything we're going to do today is on our website. And so let's go into it, Chris. Let's talk about the debt service coverage ratio and cover some of the highlights here, please.
Okay. So we have basically, well, to start with, the debt service coverage ratio looks at the coverage ratio, which is the basically the rent divided by the mortgage payment. In the past, the rule of thumb has always been a 1-to-1 ratio. So we've expanded that, but we do look at the coverage ratio, and sometimes we have a no ratio program too. The minimum FICO is 680, and the maximum LTV is 85 now on this program. So that's really good for, you know, somebody who really doesn't have a huge down payment. We also raised our loan amount to $3 million on this program, which has really helped us a lot in those markets where, you know, you might have a short-term rental or you know, a property in California, for example. Qualifications, again, are based on cash flow, although we do have a no ratio program as well. We can have a property in an LLC. We can have a vacant property on a refinance, which is great, and no limit on the number of properties they own. So that, just having said that, a lot of you have customers or borrowers that have, you know, 10, 20 properties and they don't qualify. We don't really care about the number. It's a 30-year loan. We also have interest only available, and loan amounts greater than 1.5 million. We do require a second appraisal, by the way. I guess this has become probably the most popular part of the product, is the warrantability of condos. There's been a lot of changes in Fannie Freddie with condo warrantability. We've been getting a lot of those loans. We have a, you know, pretty liberal non-warrantability program, so we encourage you to show those to us. We allow non-permanent residents. Condotels, that's been extremely popular. We can do condotels now, which is great. And on our short-term rental, we'll talk about this, but we can use AirDNA reports, which is cool. Yeah. And again, just we also offer states where you're not licensed, and those are listed kind of on the screen there. So.
Yeah. Yeah. So we had a guest appearance here. So. Oscar was having some technical difficulties, so I'm going to hold up the whole show just for you, Oscar. So, no, Oscar, please introduce yourself, please.
We always make them interesting, right?
Yeah, exactly.
That's how everybody knows these are live. They're not pre-recorded.
Right.
Sorry to cut you all off, but my name's Oscar. For those who I haven't worked with yet, I've been with the company for 7 years, and I love being on these webinars, so I did everything I could to make sure that I fixed the tech hurdle that I had to get back on.
Right. So, thanks, Oscar. Well, we're going to put you right into the fire here. Go over. Chris covered the highlights, right? So we're also going to cover, you know, what we want to see on a 1003, the loan application, what we want to see for credit. So, Oscar, go over what we want to see, and probably most importantly, what we don't want to see on the 1003.
Absolutely. So to keep it, I'm going to start by keeping it very simple, and then I'll get further into detail. The 1003 is the DNA of your loan. It's going to tell us the full story of the loan whenever we're pre-reviewing your file, your 1003 and your credit report, to check if your borrower meets the initial requirements, because that is the type of relationship that we have with our customers. That's an added value that we offer for you. So on a debt service coverage ratio loan, as Chris already covered, there's no income and employment, so you can leave that off of the application to begin with. We can also work with TBD properties, so you can have that as your subject property address to start to send that information over to us. But aside from that, we do want everything else on there. We want to see assets, as Chris has already mentioned. We need assets on this loan. We want to make sure that our client has the reserve requirement that we need only on the subject property of 6 months. We want to see any real estate owned by the borrower where they're personally obligated on that real estate. So if they're personally obligated on the loan or on title, if they're on title, then we want to see that listed on the 1003 as well. If it happens to be a non-recourse loan where it's business purpose and it's not in, if it's possibly titled in an LLC or the loan is in an LLC, then you can leave off of the 1003 to save yourself some time. On refis, especially, we'd like to see how long that property's been owned. That can help us out. That way we know if we have a cash out, that your client has at least met the seasoning requirement on that property to use the appraised value. And if not, then we can always, if they've owned it less than 6 months, then we can always opt for delayed financing as well. Those are alternatives that we can go over further and shortly. And the full declarations page, something that I'm seeing time and time again. If that application is not complete and then you upload it into our system, you're going to have to fill it out because we're going to need a full application anyway.
Yeah, thanks, Oscar. Chris, kind of go over, trade lines. What, and usually, you're gonna probably hear us all talk about this sounding like it's for a seasoned investor. We do allow the first-time investor on this, but Chris, talk about what you like to see or what we require for credit and trade lines.
Sure. And yeah, we're one of the few that don't ask the question about seasoned investor. We really want to know that they own an owner-occupied residence. That's the first thing that we usually look at in this product. But our trade line policy is pretty simple. We either want 2 trade lines with 24 months history or 12-month history for 3 trade lines. And we typically want to have a mortgage rating too.
Yeah, and one of the things we do here at Angel Oak is, we make a lot of exceptions. And I know Chris just said, in a lot of cases, we'll say they have to have a primary residence, but if they're renting in say New York City or wherever else, but have a history of owning investment properties, we'll allow them not to own a primary. So just want to make sure we're clear on that. We already have some questions coming in. Guys, I know a lot of stuff has changed. So if we have to look at our matrices, let's look at them. So Tony's given an Oscar a shout out. Okay, here. And Milton, we will go over what the AirDNA, I have an example of one here. Oscar, what is the minimum FICO for the 85% LTV?
720.
Yeah. And that 85 LTV does not have MI. So just want to make sure that. Chris, Irene is asking, is there a prepayment penalty on
Yes.
debt service covered?
We do have a prepayment penalty, but we also have options where you can buy out of it or take it down to, from a 4, 3, 2, 1 year prepay.
Yep. Some other questions. I know Oscar, we allow them to close in an LLC. Do we allow S Corp, C Corps?
Yes, we do.
Yeah. So those are great questions. Keep the questions coming in. Chris, do we allow 1031 exchanges on this?
We do.
Yeah.
And a lot of times, by the way, if they are a renter, we would definitely allow a 1031 exchange on one of those. So.
Yeah. Oscar, I know some people have asked about I'm going to scroll down here where can you just go into the details of the debt service coverage and if you don't mind just doing that for us.
Don't mind at all. Very simple formula. I'm going to start with an example. I'm going to use an example of a purchase. So if you have a client who's looking to buy, let's say, a single family home, the way that we're going to evaluate the DSCR is by once the appraisal comes back, let's say that you're going to have to order your 1007. Once that appraisal comes back, the underwriter is going to look at the average market rent designated by the appraiser on the 1007, and they're going to take that average market rent and they're going to divide it by your PITI or PITIA. Okay, so in this example below, in the few examples that are below, if the rent is 1,100 and the PITIA is 1,000, that is a ratio of 1.10. You have positive cash flow at that point. I'm going to use another example. Let's say that you have a rent of 1,000 and a PITIA of 1,000, that is 1. And so what we allow when it comes to DSCR, if the ratio is at 1, we're okay with an LTV of 80% up to 85%. If the DSCR is less than 1 down to 0.8, we're okay with that too if your LTV is at 75%. with a 720 FICO. And if the DSCR is less than 0.8, here's an advantage that we have. We allow negative cash flow below 0.8 without a floor. So we'll go up to 70 LTV with a 720 FICO score with a DSCR less than 0.8. So 0.8 would be the rent covering 80% of your average market of the PITIA. So let's say $800 as the average market rent divided by $1,000, that's 0.8. The rent covers 80%. Less than that would be a rent of, let's say, $600 and a PITIA of 1,000, right? We're okay with that scenario, again, at 70 LTV with a 720 FICO score.
Yeah, I think some people, Oscar, are really, you know, and we have another account executive on the East Coast. He calls this a bulletproof loan because, even if it doesn't take DSCR, net investor, we all know why investors will buy maybe a property that's not cash flowing because they see the appreciation. I'll throw out a stat here. Since 2019, the average home across the U.S. has appreciated about 48%. So they're seeing how they're going to build their wealth through their home appreciation. Chris, a couple other questions coming in here. How many units will we go up to?
We're 1 to 4 units.
Yeah. And I want to make sure everyone understands we'll do non-warrantable condos, and we're not going to reduce the LTV based on the condos.
I will, by the way, say that the multi-unit properties cash flow pretty well. Yeah,
it's hard to find them. I hear people, investors, that they can't even find them sometimes. So, this is Len's asking a question: can the borrower occupy 1 unit and have the 3 other units rented? Oscar, I'm going to throw that question out to you.
They cannot. That would make it an owner-occupied property.
Yeah. So sorry, Len. A couple other questions. Chris, you mentioned about a vacant property. Can you go into maybe some details on that, on how we will lend or even do a refi on a vacant property?
Sure. So by the way, on purchases, we don't care if it's vacant. But
Correct.
Up until recently, we now allow vacant property, and we do hit it for FICO or LTV, I think 75, I think. I'm just looking.
Yes.
I think it's a 75 LTV. We allow vacant properties now. So, there's a lot of situations where somebody remodeled it, or they changed it from a short to a long term, or vice versa, and it's just not currently occupied. So we can.
So Oscar, on recent enhancements, seller concessions.
Seller concessions up to 6%.
Yeah, that's big, guys. Up until about 3 months ago, it's always been 3% on investment properties. So that's really good to, whether you want to buy down the rate, buy out the prepayment penalty, stuff like that. Chris, just another recent enhancement. What about gift funds?
Yeah, we now allow gift funds, which we never did before. Borrower still has to have 10% of their own funds plus reserves, but it's cool that we now allow that. So
Oscar, Rod's asking here, are these loans reported to the credit bureaus?
They are. So the borrower is going to be personally obligated on a note, but they can invest title, as we said, in a corporation for liability purposes.
Yeah. And Sherry, yes, this is being recorded. We will get this recorded out to you before end of day tomorrow. But just want to make sure everyone is aware of that. So thank you, Sherry, for reminding me to bring that up to everyone. Other questions here. I know you talked about it earlier, Chris, when you were going over the amount of properties can be financed. We don't care, but kind of go over what Angel Oak has as a guideline for exposure to one investor.
So when you mean in terms of like the number of properties?
Yeah, number of properties. Sorry.
Like a recent accelerated purchase, like we don't like it if they've recently acquired a bunch of properties. And the other thing I will say too is we do care about the credit history on those properties. So we do look at the the credit profile of each mortgage they have, if they have a mortgage. That's really important on the number of properties. So,
but and usually these come in multi-packs, right? If you're doing refinances or cash outs, I know one of our A's on the west coast of Florida, she did a 10-pack. So what I was trying to refer to there, Chris, is our exposure. Get ahead.
Yeah, I mean, we typically want like no more than 6 loans, but we have made exceptions, like a 10-pack, for example. And it goes with anything though. Like we have guidelines, but we also have exceptions. So please send us the pre-approval request so we can get the exception approved for you.
Yeah, and we're going to show you how to price these loans. We're going to show you how to get these loans. And really, I think the most important thing we're going to show you here today is how to market to find these borrowers. So, Oscar, how long does it take, you to do a typical pre-qual on debt service coverage ratio loan?
If I have everything that I need on the 1003 and the credit, it should take less than 20 minutes.
Yeah. So, and then Chris, what's your average time to close these loans, Chris?
I mean, they're running like 3 weeks right now.
Yeah. Yeah. So that's, that's a pretty impressive. And again, I think, as Oscar mentioned, what we like to see on the 1003, we'll move as fast as you want us to move. And a lot depends on if you or your processor or anyone else is really working with the borrower to get us information. But there's really not that much information. No job information, no income information. It's really the appraisal is the time that is taken, and they're coming in pretty fast. Do you offer these in Nevada and Texas? Oscar, I'll let you take that.
Yeah, we do. And we also have 12 states where you don't have to be licensed in order to do these loans. And they're at the bottom, very bottom of the screen. They're highlighted in green. They span from Colorado to Wisconsin.
Yeah, and I think go into a little bit more details, Oscar. What if a LO is licensed in Texas, where I'm located, and they wanted to do a debt service coverage ratio loan in Florida?
They can do it. They can do it. We just have some paperwork to fill out for compliance reasons, but that's it. It's a simple signature, and then from your company, and you can go ahead and get started on doing that loan.
Yeah. So I've had a lot of questions about AirDNA, and so I'm gonna pull up an example, and just so everyone's aware that AirDNA, to get access to this information, it doesn't cost you anything. You can sign up for a free trial and get access if you know there's a property up front. Oscar, I'll let you talk about the AirDNA side of it, and what are the certain criteria that we require for a property to qualify using AirDNA?
Well, one of the benefits, I'll start with the benefits of having AirDNA as an option. One of the major benefits that we've seen, especially on the larger loan amounts, normally you see Airbnb properties that are higher value. And before, when we were only using the 1007 in the example that I gave you earlier on how to calculate the DSCR, those higher loan amounts with where rates are today sometimes would not cash flow positive. And what would happen is then the LTV would have to meet a DSCR requirement of, let's say, 0.8 or less, which would mean 25 to 30% down, as opposed to the 20% down. And sometimes at those higher valued properties, borrowers were not willing to put the additional 5 to 10%. They may not have had the money at that point. But with AirDNA, the short-term rental income, in theory, should be a lot higher than you would get for an annual rent. So that's the benefit, and we've seen success with that, especially on those higher value properties and those higher loan amounts using AirDNA. So AirDNA is a website. It's just an aggregator of information from websites like Airbnb and VRBO. And it takes all of the short-term rent and it gives you an estimated rent based on the property that your client is shopping for. It's the service. They have some services that are free. They have services that are paid for. But this property earning potential report, the one that we need to use, and it's all that we need, you can actually download using the free version. And all you need to do is create you just need to create your username and your password, and you'll be able to log in. Now, what we're looking for is a purchase only. We can only use this as a purchase for now. And then the occupancy rate has to be over 65%. The market score has to be equal to or greater than 70%. And we're going to use the projected revenue from AirDNA and divide that over 12 months. And that is what our average rent would be and what we use to calculate the DSCR.
Yeah, so in this case, this one would be $5,000. If you took the 69.9, you would divide that by 12, and that's $5,825. That's what we're using to cover the PITIA. So it's pretty simple, and we're not using a percentage of that projected revenue. We're using all of it. So we're not using, it's the same on the 1007. We're using the entire 1007. We're not doing 75% of that. So just want to make sure everyone knows how to use this. So thank you, Oscar. Hey guys, I know we're about half past the hour. I do want to go over another program that falls under our debt service coverage. Before we go, Oscar, I do want to ask one last question here regarding AirDNA. Do we still need an appraisal with the rent schedule on it?
Yes, we do.
Okay, thank you. So hopefully, I forgot who asked that. Tony, hopefully that answers your question. So Oscar, you want to go over the foreign national program, go over some highlights, and we'll talk about that.
Yeah, one last bit that I wanted to mention about AirDNA. We're just as aggressive when it comes to the DSCR. So we also allow negative cash flow with AirDNA.
Yeah, thank you.
The foreign national program is meant for borrowers that live and work outside the United States that want to purchase a investment property in the United States. And it's a more simplified version of the DSCR version of the program for someone who's a U.S. citizen, permanent resident alien, or non-permanent. The reason why it's more simplified is because we're not looking at credit at all. We're not going to need to see credit. We also don't need employment. There is not going to be any DTI. We're not going to ask you for any employment or credit reference letters either. So it's a simple program. The main differences are that the DSCR for foreign national needs to be 1 or greater. So we don't allow negative cash flow for the foreign national option. The other very important piece that you do want to make a note of is that we require seasoning of the funds. The funds need to be sourced or seasoned for 60 days, sourced and seasoned for 60 days, and 30 of those days need to be in a US FDIC insured bank account. That will impact your closing timeline. So you want to make sure that money is here for at least 30 days.
Yeah, Oscar, I'm going to interrupt you 1 minute on that. So if you know that you are going to have to source and season those for a total of 60 days and 30 days here in the US, and one of the A's on our Florida team always says, bring in extra money just in case it doesn't cash flow, and then therefore you can put more down to meet that cash flow. So I just wanted to bring that up, which I thought was brilliant. So
yeah, that's a pro tip. You definitely want to make sure to have some. You definitely want to make sure to have some cushion in case you need to put a little bit more down to bring down the loan amount in case the DSCR is just below 1 to get it to 1. So your average rent would equal your total PITI or PITIA. The 12 months reserves can actually stay in the home country in the home bank account, so they don't need to transfer those funds over. They cannot close in an LLC. Oh, I'm sorry, it is permitted. It is permitted.
that was an enhancement. a recent enhancement.
It is a recent enhancement. We, part of the conditions we're going to want to, they're going to have to fill out a form so that we can auto debit ACH for their payment. And we have the visas that are required there at the very bottom. If the country happens to be on the visa waiver program, that's not necessary. So whenever you're putting together a foreign national loan, the key things that you want to get are the visa from the borrower. Obviously, you're going to put together the application, but it's going to be a very simplified version of that. You're not going to have to pull credit, and you want to collect their funds for their bank statements for the last 60 days to make sure that your funds have seasoned.
Yeah. So Kendall is asked a couple of questions here. She obviously tried to close a DSCR loan with another lender, and thought the experience was difficult, I guess, at best. So Kendall, a couple of things we'll do for you, and as Chris mentioned, these come in multi-packs. If we know ahead of time that you're sending 3 of these loans in, we'll send those to the same underwriter. Those are the things that we do here at Angel Oak to make your and your borrower's life a lot easier. So anything else, Chris or Oscar, on foreign nationals?
It has to be a true foreign national. So we get a lot of questions if they're living in the United States. They really have to live in a foreign country. I will say too, I'm getting more of these than I ever gotten in the last 8 years this year. So I think, all the migration we've had to our country, there's a lot of people that are wanting to buy property. Maybe their kids are going to college, but for whatever reason, I'm seeing a lot more of these.
Chris, you're 100% right. There's so much geopolitical strife in the world today. And I think people are, yes, it's an investment property here, wink, wink, but, who knows, if they're going to end up having to move here. And Chris, you mentioned another thing that, we'll talk about marketing here in a few, but, a lot of people are sending their children to university. So I always throw out the marketing tip, look at these large universities, and maybe that's a way to market, to a different source. So if they're sending a child here who wants to pay room and board, they could actually invest in a property, and they have that for the rest of their life, or as an income producing property.
And I will even add that I think the U.S. residential house is one of the safest assets in the world. That's recognized around the world. So there's a lot of foreigners buying U.S. real estate.
Yeah. So, and similar to what Oscar talked about, the 1003, we don't require this person to own a primary, right, Oscar?
No, we don't.
And we don't need the job. We don't need income on it.
No.
Even talk about credit for foreign national.
There is none. Yeah.
So the debt service coverage ratio for a U.S. citizen or a non-permanent resident alien is bulletproof. This is I don't know what's better than bulletproof, So, yeah. It's a real, it's really easy. So I know we've had a lot of questions come up about pricing. We've had a lot of questions come up about how to submit a pre-qual. So let's do this. Chris, Chris, let's take me through a quick quote. So yeah, take me through a quick quote.
When you send us a pre-approval, you actually do it on our site, and you don't have to log in. So don't worry about all the pressure of getting logins and all that. It's so simple. It'll take you a minute or two to do it. The cool thing about our pre-approval process is it actually creates like a little mini file. We don't disclose or anything, but it's just a mini file where we can price the loan out, just make sure it fits our guidelines. And then you can submit the required docs. And on this one, it's simple. It's just a credit report and a 1003. So you go to our main site and you click on the non-QM quick quote. And then the menu will pop up, a bunch of little menus there. You want to put the type of loan, first loan, then the loan amount, the credit score, 680 minimum, the loan to value, let's just choose, 75. The state that the subject property's in, that will also determine if you can do it as a non-licensed person. The type of transaction, the property type, the housing history, and then the income piece here is the most important. So DSCR, investor cash flow. Then it's going to ask you to put the licensed state above. So we'd put the state there, investment property, and then the prepay penalty. You can choose in that section as well. And then put in the licensed state, the state up above, and that'll.
Oh, sorry. Yeah. Sorry.
Yeah.
Sorry about that.
So Colorado, which actually I think is a state we can do if you're not licensed. So then you're going to see a program. That's just a base rate that you're looking at, borrower paid comp. Then you can typically just view the rate so you can see, how that program is paying. This is an interactive.
Before we go there, I just want to say, so we requested a 75 LTV. They qualify for an 85, but this is the par rate of 7.875. And I've been hearing lately, and maybe Oscar or Chris, you can not verify, but we're pricing better than a lot of government second homes and investment properties because of all the LLPAs that they're putting on there. So if you're used to doing conventional, give this a shot if you're looking at a second home and investment property. Sorry, Chris.
I'm definitely pricing loans that are actually quoting below a conforming loan. I've never seen that in the 30 some years I've been in this business.
Yeah.
So am I. It's saving borrowers a lot of money.
Yeah. So this is kind of an interactive system because, there's ways to change the rate here. You can see that we're paying an eighth at 7 7/8, but that's with a 3-year prepay. We could bump it to a 4-year. We can bring it down to, we can bring the prepay down. This is also assuming a 1 coverage ratio or better. We also have the option to change that, and the pricing would change accordingly. But a lot of times we'll get emailed, what's the rate on X? And we give that. Then, oh, what if you do this? So if you can get into Quick Quote, it's really helpful. You can answer all your questions that pop up as you're pricing out a loan. This is also the site where you send us the pre-approval request. So should we go into that?
Yeah, let's do
so
it.
what you would do is just choose a rate, and you don't have to keep that rate. You're going to go now upload your 3.4 if you have it. If you don't, we can click next. And then answer some basic questions about you and your company and the AE that you're choosing. And then you're just going to drag and drop your 1003 credit and 1008 in these 3 boxes. If there's additional documentation, like you maybe have an appraisal or something, you can throw that in there too. And then hit submit, answer the 3 questions and hit submit. That goes directly to us. And like Oscar said, we can typically approve it in a half hour. If we have to get an exception, we actually take this file and we run it through our credit risk department to get you the exception that we're looking for. And sometimes that can take up to 24 hours. So.
Yeah, Chris, thank you for saying that because, you have Chris here, 8 years, Oscar, you've been what, 6, 7?
Yeah.
Yeah. So these guys and all of our account executives across the country are basically pre-underwriting that file. Now these files, they don't take that long because we're looking at the 1003 and we're looking at the credit, and if everything is what it is, like Chris said, they'll pop out a pre-qual in 30 minutes. But if Chris or Oscar or any of our other account executives across the country are not 100% sure, or we're needing an exception, that exception gets asked. And as Chris said, that could maybe take up to 24 hours. If we get that exception, and if everything is presented, that exception follows that file all the way from disclosures to underwriting to closing. So they are not only subject matter experts on this program, they're subject matter experts across the entire program at Angel Oak. So working with an Angel Oak account executive is critical, and will be a very professional experience for you on you, your borrower, and your referral source behalf. So anything else, Chris, to add? Thank you for bringing it up. That made me
I would just say more than any other company, I think when we do a pre-approval and get an exception, that is, you can take to the bank, because if it's a TBD, you know, your agent really wants to know if this is a deal that's going to go. And we actually have it looked at by a VP of credit risk. So it's, you know, blessed by the Pope, if you will. So,
So,
John, I wanted to add one comment there. On this screen, because this happens to some customers, if your LOS at your company does not allow you to add an address on the 1003, because it'll trigger your disclosures. And they already are under contract. You can actually just type in the address here for us on the additional comments box.
That's a great point.
I like to see the property, and I like to look at it with customers. You know, we're at the weight of we're at the mercy of the appraiser when it comes to the average market rent and the value. But there are some tools that we can use, and they're not even very sophisticated. They're free and they're on the internet, that we can do to sort of prepare, you know, and get an idea of what our average market rent may be. And we showed you AirDNA. There's no more established version than AirDNA right now for short-term rental income. There isn't something as great to use for your average market rent, because but we can always go on Zillow's Zestimate or Rentometer.com just to get an estimate of what the average rent may be for that property that your borrower is buying, and we can then gauge what our DSCR is. This way we can really structure our loan, and you can put your borrower in a good place.
That, Oscar, can't say it any better. And that's the professional on the side. You have Chris and Oscar here, and Lynn, thank you for the comment about the rates that made this whole hour worth it. Don't leave yet, Lynn, because we're gonna show you some other great tools for you, and that you get to work with Kim Gilder. That's even a bigger bonus, Lynn. So that's awesome. So let's go. You know, we always talk about, you know, innovative solutions for underserved borrowers. That's our title on our website. But Oscar knows where I'm going with this, because we've done, Chris probably knows where I'm going with this, because we've done a lot of webinars. I think the most underutilized portion of the Angel Oak website is the marketing portal. So let's, Oscar, take us into the marketing portal, please.
All right, you're going to find the marketing portal directly on the site. You're going to log in as you would. If you don't have login credentials, if you don't know who your AE is, you know, take these next few minutes just to type in our chat history in the chat box. It's here at the bottom right, and just mention that you'd like to know who your AE is. This way you can get connected, and we can get you a password so that you can get set up in our system. If you're not set up with us, they'll reach out and they'll get you set up. This way you can access the marketing portal. Really, like we say, it's underutilized, but it's a great resource for you, because we all have plenty of scenarios where customers have taken our marketing pieces that we put together that are completely unbranded and easily customized on the website, and using that to promote it either through Facebook or let's say LinkedIn and other forms of social media, and have had success with more applications. So once you've logged in, right at the top of the screen there, it says marketing portal, and you can access the flyers, the presentations, the social media content, and the whiteboard videos that we have. Let's start with the flyers. Like I said, everything is completely customizable. So you're going to have a complete view of all the flyers as soon as you sign on. And then we're going to choose that investment. Let's choose the investor cash flow flyer. To the left, and so this is our training portal. So when you sign on, everything is going to be customized for you, you know, and it'll be private access for you. To the left-hand side is where you're going to fill in all your information. And then you'll notice that at the very top, there are 3 buttons in green that say left logo, right logo, and photo. That's where you can upload photos. We've seen loan officers co-brand with realtors. So maybe they'll add in their photo along with their own and then their contact information. But as long as you fill in your name, you know your phone number and where you're located, you've got your own marketing team. You don't have to go reach out and spend more money on it because we have it all done and you don't have to reinvent the wheel. Once you fill this out, if you want to, let's say, download a flyer for a completely different option that we have, a different investment flyer that we have, all you have to do is click that drop down menu and then let's choose investment property. And when you do that, it's also going to auto-fill. So you don't have to re-enter the information. All you have to do is click the download button and it'll download directly to your desktop. That easy.
Yeah, it's really simple and user friendly. And I challenge everyone on this call and to really take advantage of this. So I'll get off my soapbox there. So go ahead. Chris, anything else about flyers at all?
It's just really helpful when especially when you're doing a realtor presentation, just something you can put your own brand on. You don't even have to mention Angel Oak. And it just kind of goes part of our service. We'll present with you as your investor. We want to make you armed with data that will help you with your referral partners, your even CPAs and attorneys too.
So let's, Oscar, almost forgot your name, Oscar. How could I have done that? Let's talk about social media posts, Oscar.
Well, social media posts. So as I said, you don't have to reinvent the wheel. Even if you're not very confident on how to describe the program, we've already helped you with that. Every single image here has its description and its targeted audience. So if you're looking to send this out and the message is meant for realtors, then you have a caption here that you can copy and paste for realtors. If it's meant for borrowers, then we have that here for you as well. You'll see it says borrowers right there. Every single picture, I just learned this recently. You'll notice that it says Instagram and Pinterest or Facebook and LinkedIn. All those dimensions are perfectly catered for those social media sites. So all of it should be able to be easily read and in really good quality. And now something, Chris mentioned something really important. He mentioned the realtor presentations. That's something that we voluntarily do, and we do them on a weekly basis. Nearly most of us do them on a weekly basis. This isn't something that we schedule. These are our customers are reaching out to us so that we can co-present with them. So again, you don't have to be an expert on this because we are, but we'll be there with you side by side and we will co-present with you, and we're going to go over the basics with your realtor partners to teach them how they can grow their own business and their commissions using the debt service coverage ratio program and other non-QM programs as well. I would say that before scheduling the presentation, just get with your account executive and get a date and set a date and time. Take about 20 minutes just to cover the program and the details that you do want to mention, and then from then on, just schedule the call. I don't think I've ever heard anybody get denied when they schedule a presentation, especially when you pitch it that you're going to teach them how they can earn more money, for example, in 2024. No one's going to say no. In fact, they should probably be buying you coffee or at least getting you lunch. All of us have access to Zoom. So if you happen to have some realtors that are further out, or maybe they can't all get together in an office, then you can schedule that with your account executive. If you don't have Zoom, they can share their link with you and you can provide that to them, and that way you can get on that call. This is the realtor presentation in PowerPoint, a PowerPoint version. Again, it's unbranded. It's just missing your logo, your name, and your contact information.
Yeah, Chris, I mean, Oscar, I believe this is one of the most powerful presentations you can have Angel Oak do on your behalf. Whether we like it or not, I believe realtors pre-screen borrowers. And I'll give an example. I was at an industry function and I was talking to a loan officer who was also a CPA. and she had never heard about a bank statement loan for a self-employed borrower. And that's someone in the industry. Now you exponentially do your referral source, which are realtors who are once, maybe twice removed. They never heard about these programs. And we always say this, 9% of the loans we close here at Angel Oak are for realtors. And I can promise you that if you get 12 or more, do the math, get 12 or more in a room or on a Zoom call, you're going to get a loan out of one of them. And so I have an AE here in the Dallas-Fort Worth market. So you talk about marketing opportunities, right? He did a search, a Google search on real estate investment clubs in Dallas-Fort Worth, and he stopped counting at 20. So how great would it be to show up with an Oscar or a Chris or a Tom, the guy who did that Google search, and present to a real estate investment club just about debt service coverage ratio program. So it's, it's work with your AE, because I'm telling you, they have even more, they have greater ideas than just that one DSCR and real estate investment club thing. They've seen it. Chris has been here 8 years. He's probably helped more LOs market themselves in different ways than they ever thought about, right? So I know we're getting close to the top of the hour. And I want to be respectful of everyone's time. So, but I'm going to use this one example. And Lynn, I know your account executive is Kim Gilder. Kim Gilder will go in there on your behalf, Lynn. Doesn't say anything about Angel Oak. Just says that Lynn has access to all these great programs and is going to drive the conversation always back to Lynn. So, and Oscar's going to do the same. Chris is going to do the same. All of our AEs across the country are going to do the same, and they're willing to do it, as Oscar mentioned. So, Chris, anything in closing that you want to bring up?
I would just say that most of the AEs at Angel Oak, we have a lot of experience in this business, like myself, like 35 years. This is still a relationship built business, and we're here to help you build relationships and trust. So any way we can do that to help you that's why we're here. So
Lynn just put in a comment line that her and Kim have done one of those realtor presentations, and I'm sure Kim knocked it out of the park. I wish I could bring Lynn in as a testimonial here. It'd be awesome, but thank you, Lynn. Oscar, anything else in closing?
Yes, for those of you who have stuck around with us till the end, I wanted to share some golden nuggets with you. We, Chris and I, I'm sure, have customers that make a living off of debt service coverage ratio loans and commercial and other business purpose loans. And over time, they've shared their number one sources with us, right? Their number one referral sources are commercial lenders, hard money lenders, and banks.
Yeah.
Commercial lenders are commercial lenders that stay in their lane and only lend on commercial property. If their customer comes to buy a, let's say, 1 to 4 unit property, they'll refer it out to you. That way you can help them with a DSCR loan. The banks, those are especially good for non-warrantable condos and condo hotels, which we also do on the debt service coverage ratio loan. And then the hard money lenders, well, typically someone's using a hard money loan either because they want quick financing and it's an investment property, and then they want to refinance into something 30-year fixed. And also because they may have accumulated more properties and have too many finance properties. They no longer qualify Fannie Freddie, or they run into a DTI issue, and we have solutions for them on this program. So you want to make sure to market yourself to those three referral sources.
Yeah, that's awesome. So I guess we'll wrap it up here. Chris and Oscar, thank you always for your time, and your expertise and friendship. It's I never lose sight of all that. So everyone, this was recorded. This will be sent out before end of day tomorrow. If we didn't get to all your questions, I promise we will have your account executive reach out to you. I believe I put my contact information down there to everyone. If you need to get in touch with your account executive, just email me at johnj@angeloakms.com or text me, and just include your NMLS so I can get you to your account executive as fast as possible. For those of you that have closed loans with us here at Angel Oak, thank you for your business. For those who have not, give us a shot. I promise you, you will not be disappointed. So for the rest of your 2024, non-QM is going to continue to grow and grab market share. So if you're not doing it like the 60% who have not originated a debt service coverage loan, it's probably the easiest non-QM loan to close. So give us a shot and good luck for the rest of the year. And again, thank you everyone for attending. Have a great rest of your day and hope the rest of your year is a success. Thank you.
Thank you.